Hey, what's up everybody, and welcome to another video from the Keystone Financial Academy. My name is Elliot, and today we're going to discuss the basics of stocks. If you haven't really done much with stocks and stock investing, this is the video to watch. Before we start, be sure to subscribe to the channel so you don't miss any of the upcoming financial investing topics. And if you like this video and find it useful, please smash that like button below. Okay, let's talk about stocks. This is what most people think of first when the subject of investing comes up. So what is a stock? Put simply, is the equity share in the ownership of a company. You are giving that company money, and in return it gives you a tiny piece of itself in the form of a stock certificate. You then become a shareholder and entitled to a share of the profits in the company in return for giving it money. Fundamentally, it's that simple. How exactly do you get compensated as a shareholder? Well, there's a number of ways. The most obvious is if the company becomes successful and profitable, its shares will rise in value. This is called capital appreciation and allows you to later on sell the shares for more than what you paid for them, in other words, for a profit. In other cases, the company will literally pay you to hold their stock, and you'll receive regular payments or dividends in proportion to the amount of stock that you have. The knowledge of stocks is also important because they're the underlying building blocks of mutual funds and exchange-traded funds or ETFs, and also underlie derivatives such as options. Stocks are also used to create indices such as the Dow Jones Industrial Average or the S&P 500 or NASDAQ or many others. Stocks can of course be traded, which means bought and sold, and are for the most part considered liquid assets. Numerous exchanges exist for the purposes of buying and selling stocks, such as the New York Stock Exchange and the NASDAQ here in the US. And if you want a good review of stock market indices and exchanges, there's another video called Fundamentals of Investing, and I'll leave the link in the description below. Now, the history of stocks will bring you back to the year 1602 and one very specific Dutch company called VOC. The name means this right here in the Dutch language, and no, I will not try to pronounce that. VOC was the Dutch East India Company, a very powerful enterprise, one of several in Europe, and they were tasked with running the trade between Europe and countries and regions in the Middle East and the Far East, such as India and China. VOC needed hundreds of merchant ships to carry out this trade, and they were the first company to ever create a new financial instrument called a stock and issue it to investors. The company would sell the stock to raise a lot of money to purchase, expand, and later modernize their fleet. Meanwhile, the stock paid dividends or profit on all the voyages that they undertook and successfully completed. The idea caught on, and soon all the trading companies in Europe started doing the same thing. The first dedicated stock exchanges were opened in London in 1773, followed by Philadelphia in the US in 1790, and in New York City in 1792. It took a few centuries, but the idea of stocks, the stock market, and stock exchanges really took off, and today there are exchanges on every continent of the world except Antarctica. Okay, with that brief history of stocks behind us, let's first mention the two types of stocks you can own and a number of other classifications that exist. The two main types of stock are common stock and preferred stock. Common stock is the familiar type most people own and what most people actually refer to when they talk about stocks. You get a small piece of the company and one vote as a shareholder. The one major disadvantage of common stock is if the company files for bankruptcy and is liquidated. As a common stock holder, you generally last in line to receive any proceeds from liquidation of that company. So choose who you invest in carefully. Preferred stock is relatively rare and comes with a fixed guaranteed dividend, so you get it more for income rather than capital appreciation. Preferred shares do lack voting rights for their shareholders, but they are higher in line for any money due in case of bankruptcy and liquidation. There isn't really a better or worse when it comes to common shares versus preferred shares, and it's really just what the investor is looking for. The vast majority of the time, you as an investor will likely just purchase common shares. Now, there are numerous categories and classifications of stock to make investing more organized and understandable. With this in mind, here are some industry classifications and terms that you as an investor need to know about. The first way you can classify a stock, or more accurately the company that issued it, is by market capitalization or just market cap. And that is just the share price times the amount of outstanding shares the company has. There are 4 commonly accepted capitalization classifications, and when you're investing, you'll hear about these all the time. In order of increasing size, here's what we have. A microcap is a company with a market value of under 300 million. A small cap is a company with a market value between 300 million and 2 billion. A mid cap is a company with a market value of between 2 billion and 10 billion. And finally, a large cap is a company with a market value of 10 billion or more. The second way stocks can be classified, and depending on your point of reference of course, is whether they are domestic or international. This almost always refers to where the company has its corporate headquarters and where it's generally considered to be from. Investing in international stocks is necessary for diversification and is generally considered safe if you stick to major international companies. The third way stocks can be classified is whether they're growth or value stocks. Growth stocks are typically riskier, younger companies in emerging industries, and their shares appreciate quickly. Investors buy in early in hopes of a major payoff later on, and their time horizon is generally pretty short. Value stocks, in contrast, are older, more established companies with reliable business models but little growth, and they may be undervalued by the market. Investors buy in for the dividend income and may have a much longer time horizon. Investors may, of course, focus on investing in both approaches as part of a balanced portfolio. A fourth way stocks can be classified is by dividend paying and non-dividend paying. As just mentioned, dividend paying stocks are more associated with older, more established value companies that are not projected to grow a whole lot, hence they pay out a dividend to attract shareholders. In contrast, fast-growing younger companies that sink all their cash and profits into additional growth do not generally pay dividends. Dividend investing, also called income investing, is when you only buy dividend-paying stocks and is a major investing approach, which I'll discuss in detail in future videos. Finally, we have the defensive and cyclical stocks classification. These two stock classifications are polar opposites, and investors need to balance them in a portfolio. Defensive stocks don't vary much in price in good times or bad times because they sell products that are consumer staples that are purchased by consumers in any economy, good or bad. Cyclical stocks belong to companies that manufacture or provide a discretionary good or service. This is something consumers don't need but may want, such as a luxury good. As such, these companies do great in booming economic times but get hit hard in a downturn or recession as consumers tighten up their wallets. Okay, the next topic has to do with stock splits and buybacks. If you invest in stocks for some length of time, you will encounter a stock split, a reverse stock split, or a buyback. So we need to discuss what all three of these mean. A stock split is a fairly straightforward idea. A company splits its shares by some ratio, thereby instantly creating more shares, but at the same time lowering the per share price proportionally. What doesn't change is the overall market capitalization, or market cap. Recall that market cap is the share price times the outstanding number of shares. The market cap of a company that has 10 million shares, each valued at $50, is 500 million. If the company does a 2-for-1 split, it will now have 2 shares for every 1 outstanding, bringing the total to 20 million shares. But the value of each share will then drop to $25. The market cap, however, will remain at 500 million. Once the split is announced, the adjustment is automatic in the marketplace and all shareholder accounts are updated. Why do companies split their stock? Well, the main reason is to adjust the share price if it climbs too high. The lower prices resulting from the split make the shares more attractive to a wider range of investors. In the previous example, splitting the stock from $50 to $25 might not mean much, but a more realistic split, like the one done by Apple in June of 2014, which was a 7-to-1 split, lowered the share price from $655 per share to $93 per share. This made them more accessible to less wealthy investors who might not have been able to buy in at such a high per share price. Splits also increase the liquidity of a company's stock by instantly creating more shares in the marketplace. This in turn can drive up demand for the stock as more investors view the shares as being affordable, even though you're getting less company for each share. As it happens, a share price increase typically follows a stock split, so investors are pretty happy about these. Now, if you're thinking, can a split go in reverse? Yes, it definitely can. Unsurprisingly, this is called a reverse stock split and works just like a regular stock split, but in reverse. As an example, a company may do a 1-to-5 reverse stock split, turning its $5 stock into a $25 stock, while total market cap remains the same. No new value is created, and the share price increases on paper only. A reverse stock split is not really a glamorous event as compared to a regular stock split. and is typically done to boost up share price to avoid being delisted from a stock exchange or gain respectability in the market. It may also be a sign of a company in distress. However, in some cases it may be done to reduce the amount of shareholders to comply with some regulations, or it may be the opening move to take the company private. A major wave of these reverse stock splits happened in 2000 during the dot-com bubble. Finally, a stock buyback or stock repurchase is when a company buys back its own shares from the market, thereby reducing the amount of shares still outstanding. This is a form of returning cash to the shareholders, similar in some ways to a dividend payment, but serves also to boost up share price by reducing demand, and also sends a strong message that the company has sizable cash reserves and is on solid financial footing. This action is typically done by larger companies due to the costs involved, but it can be done by any publicly held corporation. Okay, so that was a really quick primer on the fundamentals of stocks, and hopefully you now have a better understanding of some of the concepts and terminology and classifications of stocks that you're going to hear about a lot when you actually start investing. As always, be sure to subscribe to this channel so you don't miss any of the upcoming investing and finance topics, and if you enjoyed this video and found it useful, hit that like button below. Thanks for watching, and I'll see you all soon.